The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
For financial markets, January came in like a lion, but it goes out like a lamb. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld, kicking you off to the closing bell here in the U.S. on this Friday. Thank goodness. Of course, the big news today is that President Donald Trump nominating Kevin Warsh as the next Fed chair. What an interesting cross-asset picture we have to look at right now. The S&P 500 down about 0.6%. We are very slightly positive still for the week. Then you take a look at the 5s 30s curve. A really interesting reaction in the Treasury market, translating into your 5s 30s curve higher by about 4 basis points or so. The dollar having a wonderful day, higher by about 0.75% when it comes to the Bloomberg Dollar Spot Index. Take a look at silver. This is historic. You can see silver down by nearly 27%. That is the worst drop since at least 2008, Romaine.
Yeah, it's a really ugly day here for the markets overall, souring what actually had been, if you think about it, an otherwise strong month here on the final trading day of January. The S&P, which started off the year with a 1.5% rally, has now logged 3 straight weekly losses. About half the members in the red over that stretch. That includes a 10% drop in Microsoft, 15% slide in Oracle, and a 20% drop in Constellation Energy, an unwind, if you will, of some of last year's best trades. Now, strikingly, that still doesn't compare to the near unprecedented unwind that we're seeing in the precious metals space. Gold coming off its best annual performance since 1979. Today, headed for its worst one-day decline since 1983. And you had silver there on the screen. Katie, at one point, it was having its worst day since 1950.
The market was really excited about gold and silver, given the debasement trade over the last couple of weeks that really was driving up the speculative element of this. And today you're getting the wet blanket of the Fed nomination and the dollar rallying. And because of that, you're seeing a pretty significant pullback.
And the dollar rally, not even half of it. It's now put together a string of its most volatile days since the Liberation Day upheaval in April, dropping earlier this week as Trump shrugged off the greenback's weakness and rallying today partly as Kevin Warsh, Trump's nominee to succeed Jay Powell, is perceived to maybe be less supportive of those deep rate cuts advocated by other Fed officials like Christopher Waller and Stephen Miran. And that is where we kick you off to the close with the future of the FOMC and a conversation with Fed Governor and Council of Economic Advisors Chairman Stephen Miran, a conversation led by our very own Michael McKee.
Thank you very much, Romaine. And we'd like to welcome you all watching on Bloomberg Television and listening on Bloomberg Radio worldwide. And thank you, Governor, for coming in on what is sort of technically your last 24 hours as a Fed governor. Your term is up tomorrow, but you're staying on.
Thanks for having me back. It's good to see you again. Look, as you say, my term expires over the weekend, but per the Federal Reserve Act, I'll be staying in my seat until someone is confirmed to replace me, presumably Chairman-designate Kevin Warsh. This is common practice and has happened many times by other governors who have waited for someone else to be confirmed into their seat.
Now, the question is, how long is that going to take? Have you had any indication from the White House or from anybody on Capitol Hill? We know that Senator Tillis is threatening to block the nomination, but that could easily be handled. That could go away anytime. Do you have any idea how long you're going to be still at the Fed?
I have no idea. I mean, I wish I knew. My confirmation process took, 6 weeks or so? A little bit more than that. I have no idea how long it will take for Chairman-designate Warsh, but, I'm confident that the process will work and the Senate will come together.
All right, so you get to March 18th. That's the next FOMC meeting. You're still going to dissent for lower rates, and I ask because this time you only dissented for 25 basis points instead of 50.
Yeah, so I dissented for 25 instead of 50 for a couple of reasons. One of them is that we did cut, since I joined the FOMC in September, we cut 3 times. We reduced the federal funds rate by 75 basis points. That means we're less far from neutral than we were when I arrived in September. Now, I still think rates are too restrictive, as I've made very clear. I still think we need to cut interest rates substantially further from here. However, given that we've made some progress reducing rates, we can now sort of, I think, in my view, proceed at a slower pace of about a quarter point per meeting. It's no longer as imperative to move in 50 clips as it was. The other thing that happened is the labor market data did come in a little bit better, and they didn't come in to an extent that they alleviated all my concerns about the labor market. Far from it. Indeed, the labor market has been on this gradual cooling trend for over 2 years now, and it should take much more than just one data print to make you change your mind about the trend in the labor market. But nevertheless, we did get a little bit of better data, and that helped alleviate some concerns for me, but not all of them. I still have some concerns there.
Well, we got a 4.4% unemployment rate last month, and next Friday we're expecting to get the same thing. So that's 2 months at least of evidence that the labor market is somewhat stabilized, which is what the Fed was saying in its statement this last time. And yet, Jay Powell said, given the numbers that you've got to work with, it looks like PCE inflation on the core is going to go to 3% or more. The optics don't look good for cutting rates when inflation is going up and the labor market is stabilized.
So I disagree with a couple things you said. First of all, the unemployment rate, even though it's the single most important indicator, is far from the total of the information that we know about the labor market. There's plenty of evidence in the labor market data that indicates that we can accommodate additional demand for labor. There have been signs like it taking longer for some folks to find jobs, pockets of weakness among younger folks and folks that college degrees. That all indicates that there, increased part-time work for economic reasons. All this indicates that there's additional slack in the labor market beyond what's indicated in the unemployment rate alone. If you look at the employment to population ratio for younger folks, it's been trending downwards for a long period of time, and it has shown less stabilization than the overall unemployment rate is. And this is the type of thing that is concerning for me. So I disagree with the assessment that there's enough labor market stabilization that we can drop our concerns about the labor market. I still have some concerns. Now, I'm not as concerned as some others, but those concerns still do exist for me. And on inflation, I think, I've been making this argument that almost all of the inflation overage over our target is due to quirks of how we measure inflation. It's due to two things. It's due to the portfolio management services, which pick up just the stock market prices. So AI pushes stock prices higher. That mechanically feeds through into portfolio management services, which contributed 36 basis points to core year on year. A normal year is 6 basis points, right? So there's over a quarter of a point of core inflation excess that's basically just the stock market moving higher. And all of the professional investors in the audience know there's been decades of fee deflation in that industry, not inflation. So there's an error in how this thing is measured and interpreted. The other thing is housing. The way the housing inflation is measured, it's picking up the housing market rents of 2022 and 2023, not 2026 or 2027. We shouldn't be making policy based on what happened in 2022. We should be making policy based on what's happening in the next 12 months. So once you correct for these two errors, the backward-looking nature of shelter and the messed up portfolio management fees, you look at market-based core X housing instead of looking at regular core, inflation's running 2.2%. That's within noise of our target. We don't have an inflation excess of any inflation that's relevant for supply-demand imbalances of the type of monetary policy we respond to. We should not be making monetary policy. We should not be asking people to give up their jobs because of quirks of how inflation is measured. That just, to me, is not a good idea for policy. It's a grotesque interpretation of stable prices.
I am curious, Steve, just about how we start to measure things going forward. And I just want to go back to the labor market for a second, because there's been a lot of discussion about the stability or maybe the potential instability there. I spoke this morning with the CEO of American Express, and he actually talked a lot about small businesses, the kind of middle market businesses, if you will, that at least in his view weren't as healthy as some of the larger businesses. And I'm curious if there's been any meaningful discussion at the Fed about that kind of middle market of our economy.
Excuse me. There is conversations about that. People talk a lot about K-shaped, sort of K-shaped economies and things like that. And I think usually they're talking about households when they talk about that. But there certainly is an element of that on the firm side as well. From my perspective, some of that stuff is helpful for understanding where the economy is going, but I don't believe in targeting a specific sector of the economy. I believe that, the statutes that Congress gave us instruct us to target the overall macroeconomy as a whole. And I'm focused on aggregate employment, and I'm focused on aggregate inflation. And so I do see, there definitely are pockets of weakness here and there, but I'm focused on the overall levels.
But there was some discussion a few years back with Jay Powell when he did start to look at certain segments. The idea that when you look at the economy in aggregate, sometimes it obscures certain things, whether it's to the upside or the downside. Is there not any value in maybe trying to, I guess, bisect or dissect things into different sections?
Oh no, there absolutely is, because it can help you. It can help you predict where the overall is going to go, right? And I did that a moment ago with the labor market. When you, as I was saying, if you look at younger folks, if you look at folks at college degrees, if you look at folks that are marginally attached to the labor market, I think that very often they're leading indicators of where the overall labor market is going to go, and they portray additional slack beyond what just the unemployment rate itself would give you. And I think, to the extent you're seeing weakness in some small business segments like the Amex CEO that you mentioned before, that is the type of thing that I would be interested in knowing more about in terms of what it portends for the overall economy.
Stephen Miran, I want to talk about Kevin Warsh, of course. That's the big news of this morning. President Trump posting on Truth Social that he will nominate Kevin Warsh as the next Fed or as the next chair of the Federal Reserve. This has been the horse race that has been captivating Wall Street. I want to bring you this note from Neil Dutta over at Renaissance Macro. He writes that if you get a few cuts now to appease the president, you may well get tougher hikes later. Moreover, because Warsh has been a policy hawk his entire life, his newfound dovishness looks very suspect. Now, that's maybe a little bit more blunt than I would have phrased it, but there's a lot of people on Wall Street, on the sell side, who share that view, and I'm curious how confident you are that, as a Fed chair, Warsh will be the dub that it seems that President Trump wants.
Look, I think Neil is fantastic. I'm a huge Neil fan. But I think that Chairman-designate Warsh has a long and illustrious career and history as a very insightful thinker on monetary policy. I think he's a fantastic pick from the president. I think he's got enormous credibility. I think he's got enormous gravitas. I think he's got enormous respect from financial markets, from economists, from everyone. I think he's going to do just a knockout job. What specific policies he supports or he's going to support going forward, I can't answer that. I'm not him. You got to ask him those questions.
Well, I would love to, so fingers crossed there. But as a Fed governor, as you know well, the job of the Fed chair is not just their opinions on where policy should go, but it's building consensus, in the room itself. And so with the current makeup of the FOMC, you think about some of the views on interest rates, on the balance sheet. Do you think that Warsh will be able to basically build that consensus with that makeup?
I do. I do. And the reason is that he's been there before. He knows how the place operates. He knows a lot of the key figures involved. And he's got the respect and the credibility that you need to do that. And I think that people want him to succeed. I think people want the Fed to sort of have a good role in the economy, a good role in the country, and I think that they'll want him to succeed, and I think that he will be able to marshal the arguments and the evidence that he needs to persuade people of his policy views.
I want to talk about your experience. You came to the Fed from the White House, and I'm sure people said he was just put there to do what Donald Trump told him to do. Did Donald Trump tell you to do anything in particular, and do you think he told Kevin Warsh that? And even if he didn't, how did you and how would Kevin fight the perception that he's the president's man inside the Fed?
Look, the president has never, ever asked me to do anything on monetary policy. He has never asked me to do any specific action on monetary policy. He's told me his views on monetary policy, but he tells the whole world his views on monetary policy. You know them as well as I do, right? That's not a secret. He's never asked me to do anything. And I wasn't in the room with any of, Chairman-designate Warsh's conversations with the president or anybody else involved in this selection process. So I don't know what those conversations were like, but if they were anything like the conversations I had with the president about monetary policy, then he wouldn't have asked him to take any specific actions.
Well, how do you get the public to realize that?
You do that by taking policy actions that are consistent with the data. And I think that, I've laid out a case where the inflation measures that are consistent with supply-demand imbalances in the economy, the inflation measures that are relevant for monetary policy, are indicating that there's no material overheating, that there's no material inflation issues in this country right now. So by taking policy steps that are consistent with the economic data, that are justified by the state of the economy, I think you're delivering the right policy. At the end of the day, the financial markets and the economy respond to whether the policy is the appropriate policy or not, right? They don't respond to why the policy is there, right? The interest rate doesn't really care why, the long end of the yield curve ultimately doesn't really care why the short rate is where the short rate is. It cares whether the short rate is appropriately set and what the consequences of the short rate are for the economy. The motives of the people who went into sort of setting the short rate, those aren't really important. Is it the right policy for the economy or not? Is what matters. And I think that's what I've labored to work for, is to do a lot of analysis of the inflation scenario, a lot of analysis of the labor market, a lot of analysis of the economy, and put that all out there. And I put all of my analysis out there all the time. I try and be as transparent as I possibly can with my calculations. Everyone knows exactly why I hold the views I hold.
See, I am curious, once you move on back to your original role over at the National Economic Council, how is fiscal policy, meaning fiscal policy dictated from the White House and obviously through Congress itself, is that going to be in sync, do you think, with at least what you know now with regards to the Fed's thinking and Kevin Warsh's thinking? Is that going to be in sync?
Well, first, let me say that I honestly have no idea what I'm going to be doing, after Chairman-designate Warsh is confirmed. I have no idea.
You're not going back to the White House?
I have no idea. I have no idea. It's
Do you want to go back?
Well, I think I'm going to be doing a lot of thinking over coming weeks about what'll happen and where things will look like. But I don't know. We'll see how things shake out. But with respect to fiscal policy, as a member of the Fed board, it's not really appropriate for me to comment on it one way or another. And you'd have to talk to folks, in the White House and in Treasury, and I'm sure they've got plenty of views on appropriate fiscal policy that they'd be very happy to give you.
Do you want to come work here? You make a great co-host. Well, no offense to Mike, he's great too, but
I mean, there are some pretty great snacks upstairs, so it's not unappealing.
Yeah, we have a lot of good snacks on the desk right now, actually. But we should talk about the balance sheet, because one of the differentiating factors of Kevin Warsh is also his views on the balance sheet. We know that he's skeptical about expanding it to the extent that the central bank has, very skeptical about QE as well. And the point has been made to me today on Bloomberg Television, if the Fed is going to step away from a stance where it's using the balance sheet to influence the shape of the curve, that you could see long end rates go higher. That obviously wouldn't be good news for mortgage rates, which I know that President Trump is very focused on. And I wonder, whether those views hold any water with you.
About whether to do something with the balance sheet?
Yeah, whether or not, stepping away from expanding the balance sheet will translate into higher long end rates.
So, my perspective is that it is a good idea to shrink the balance sheet. I've said this numerous times, but I also think that in order to shrink the balance sheet, we need to do some regulatory reform, because there are regulatory requirements that create demand for reserves in the banks. We require the banks to hold reserves because of the various requirements under the Basel system, right? So once we do some regulatory reform, then I think we can get back to shrinking the balance sheet. It is something that I would like to do. Whether that has an effect on long rates, I think depends on a lot of stuff. It depends on how you're shrinking the balance sheet, whether you're doing roll-off or whether you're selling securities. I think doing roll-off is passive and is less likely to have a substantial effect on long rates. But I think at the end of the day, what really matters is the overall stance of policy as combined short rates and balance sheet policy. And if you're at the zero lower bound, then the short rate can't do anything. And then it's the balance sheet policy that's really setting the tone for the bond market, right? But if you're not at the zero lower bound, then in theory, you can be moving the short rate around to offset whatever you're doing on the balance sheet. And so what you're doing when you set policies, you're targeting a particular level of financial conditions that let you hit your monetary policy targets, stable prices and maximum employment. And if for some reason financial conditions were to deviate from what allowed you to hit stable prices and maximum employment, you can change the short rate to offset that and thereby get back to stable prices and maximum employment. So if you want to shrink the balance sheet because you have a principle that that you want the Fed to have a minimal footprint in the economy, for example, right? Then if that were to cause an increase in long rates, you can offset that tightening of financial conditions by reducing the short rate. So as long as you're not the zero lower bound, you have multiple tools to affect this situation.
One last question. We know now who the next chair of the Fed is likely to be, but we don't know what's going to happen to the current chair of the Fed. Would it be uncomfortable for the committee? Would it be difficult to have Jay Powell stay and be in the room when Kevin Warsh is trying to lead people perhaps in a different direction?
Look, I think that Chairman Powell, deserves a thank you from all Americans. I think his work during the pandemic recession, was part of a critical effort that really helped save the country from a second Great Depression, and everyone owes him a thank you for that. However, I really can't tell you what he's going to decide to do, and you got to get it. You got to get it from the source. I don't know.
All right. Steve, really great to have you here and really appreciate you taking time for us.
Thank you. Thanks for having me.
Stephen Miran there. He is current Federal Reserve Governor, and our thanks there to our very own Michael Mickey.
All right, really great conversation. Covered a lot of the ground there with Stephen Miran and our own Michael McKee. Let's keep this conversation going now with Nobel Prize-winning economist Paul Krugman. He is Distinguished Professor of Economics at the City University of New York, also the author of the Substack Krugman Wonks Out. Paul, it's great to have you with us. So let's start high level, because I know that you've been posting about this on Substack this morning. Would love to hear your reaction to Kevin Warsh being nominated, announced as President Trump's nominee, and what you make of the reactions to that as well.
Okay, so there's a lot of politeness. A lot of people here are not saying what they think. I mean, Warsh it could have been worse. I mean, that's I guess what we learned recently, the last year is that things can always be worse. But Warsh is very much a departure. I mean, in the past, the Fed chair has always been someone generally regarded, very highly regarded as an analyst, as a judge, somebody with broad bipartisan support. That's not what's happening here. Warsh he's not a complete partisan clown like some of the people who've been floated for this position, but he's very much a partisan. When people call him a monetary hawk, that's not true. He's only a monetary hawk when a Democrat is in the White House. If you actually read what he said about Fed policy, and I have, unfortunately, had to read quite a lot of it, it does feel like you're sticking your head in a bowl of oatmeal. It's very obscure, very confusing, but somehow the bottom line is always the Fed is wrong and needs to be, torn up root and branch. So this is a very big departure.
Right.
He's not as crazy as some people, but it's a very big departure.
Well, as we were just discussing with Stephen Miran, the Fed chair is one vote among many. What they really need to do is build a coalition. And you write in your Substack that Fed chairs can only drive policy through persuasion. So expand on that a little bit, because obviously it's all about building consensus here.
Yeah, I mean, so the Fed is most of the people on the Federal Open Market Committee are going to be relatively non-political. They're going to be regional bank presidents. They're going to be people who were appointed for their expertise. Obviously, some are identifiable Democrats, some are identifiable Republicans, but traditionally, and I think will still, for the most part, vote based on what they think is necessary for the Fed's mission. Fed chairs need to be effective small-scale politicians. They need to have the respect of everybody involved. They need to be able to bring a consensus with them. We've been very fortunate in that. I mean, we've had two enormous economic financial crises, in the past 25 years or so. One was the financial crisis in 2008. The other was the COVID shock. In both cases, the Fed took extraordinary measures, and I think you could say saved the world, by doing remarkably aggressive, innovative things that had to be done to keep the markets running. And it turned out that both Ben Bernanke in 2008 and Jerome Powell in 2020 had the ability to lead that kind of coalition. Maybe Warsh will surprise. He hasn't seemed to be that kind of person, but until or unless there's a crisis, not much will change. I don't think President Trump wants interest rates cut by 300 basis points. That is not going to happen. It doesn't matter who the Fed chair is.
Well, that's one thing I'm curious about, Professor, too. I mean, obviously there is the actual change in rates that could come one way or the other, but there's also the way that you communicate with the market, particularly in kind of the post-Bernanke press conference era. Bernanke was relatively deft at it. So too was Whalen. I think Jay Powell got relatively high marks. I mean, the president himself has said that one reason why he liked Warsh was, he seemed like, the kind of person, who would be great on TV, which seems to be a qualification. The markets, though, are they going to actually believe what's coming out of his mouth? Does he have not just the ability to communicate, but the gravitas to convince us that what he's saying is the way things are?
Yeah, that's very questionable. It's, if you actually parse the text of things that Jerome Powell has said, or that previous Ben Bernanke, or actually Janet Yellen had said, they were very clear. So they were. It was not just about style. I mean, it is kind of alarming that President Trump's post about Warsh basically said he's from central casting, so he looks like a central banker. Is that really the key qualification here? But they were very clear. Warsh is not. Warsh historically, just leaving aside the question of substance, you read what he wrote, and I've studied this stuff for a long time, and I come out of it saying, what did he say exactly? And that's not a good thing. Now, it's also true that we overstate how important it is. I mean, that the markets believe most of the time, whether the markets are, get the message that the Fed chair is trying to give after a particular FOMC meeting.
Yeah.
It's a lot less important. Your living is about reporting on markets minute by minute. Mine less, but still, but normally the real economy doesn't care very much about what the bond market thinks on a given day. It's in moments of crisis, when you really need, when you really need the Fed chair to be able to say, we've got this under control, and people believe it. And that's, I hope that we don't have that test for Warsh, but I'm not really confident that he can pass it.
All right, Paul. Well, we appreciate getting your insights and analysis right in the moment here. Paul Krugman there, of course, Nobel Prize-winning economist, now a distinguished professor of economics at the City University of New York. And, of course, he has that Substack, Wonks Out. I actually encourage people to go read it today, whether you agree with his points or not. Very pointed comments supported by some very pointed examples.
Yeah.
I'll leave it at that.
Absolutely. I did like
Not necessarily safe for work.
That's true. That's true. Maybe open it on your phone. But
Yeah.
I did like his line that, Fed chairs, they have to be small-scale politicians, because that's been the tone of most of the conversations I've had today, that, again, the Fed chair, one vote among many, you have a whole coalition that you have to try to build when enacting and making monetary policy.
And yeah, to his last point, too, this idea of whether the market's going to pay attention to them. We kind of, obviously, the Fed chair is a big deal for us here at Bloomberg. The average person on the street probably couldn't pick him out of a lineup, even though he or she has a big impact on them. When we come back, we're going to talk a little bit more about, I guess, maybe the average person, at least for the average coffee drinker. A conversation up ahead with the CEO of Starbucks, Brian Niccol. This is Bloomberg. A chill over New York City and a chill over the markets. 3:30 p.m. on Wall Street. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld. A chill is right when you take a look at the S&P 500. Going to close out this week on a sour note. And it's interesting, Romaine, we were just looking at it. Even some of the highest flyers look like they're turning negative today. Yeah, I was just taking a look at this here. SanDisk, these shares open higher by about 20% on the day. Shortly after the opening of the session, they got up to about 25%. There's been a steady step down, and just over the last few minutes, it actually dipped into the red. This has to be one of the more dramatic reversals that we've seen for a stock in quite some time. Obviously not the biggest stock in the world, but still, to see that type of volatility in this market, it seems like it's become a hallmark, at least over the last couple of weeks. Yeah, absolutely. That volatility, especially on a single name level, and especially cross asset as well. Just point your eyes one more time towards silver, now down about 28%. I'm going to avert my eyes from silver for now and actually turn my attention to Starbucks. The shares are down on the day and down on the week, but set up to post up a gain of about 18% here in the month of January. That'll be its best monthly performance in about a year. And to a certain extent, it's a testament to some of the turnaround that started to occur under its new CEO, Brian Niccol. He is the chairman and CEO of Starbucks, and I had a chance to catch up with him earlier today to talk about the company's international growth strategy and how the brand is holding up amid a volatile economic environment.
The thing that I'm excited about is people are saying the experience they're getting at Starbucks, the whole package, they're saying it's worth it. And we're seeing some of our highest scores through consumer claimed statements. And that's why I think it's so important that we have this great cafe experience, we have this great customer experience where it's a connection between our barista. And then look, we've always been unwavering in the quality of our coffee, our drinks, and the ingredients that we use. So yeah, we're going to be an affordable luxury item. But if you look at it, we're priced pretty darn competitively. And then I think for what you get, for the premium that we provide, I think customers are saying, yeah, I'm all in on that.
Do you think you have that pricing power right now? Should you feel like you need to pull that lever?
Look, pricing is one of those things that will always be the last lever that we'll pull. There are times where you do have to put some pricing into the business, but fortunately we've been able to hold off for the last little more than a year. So we'll see how things evolve. But, if we need to do it, we'll do it very strategically, and we'll try to do it as minimal as possible.
You're spending a lot to revamp your stores. I know that's a temporary cost in theory, but there are other additional costs you're having to deal with, including labor costs and things that are going to be more longer term and permanent. How is that factored into the forecast?
Yeah, look, obviously you always have to think through what does it cost in order to make sure we maintain the integrity of the experience. And right now we're having to come back in, we call it our Coffeehouse Uplift program, where we are just basically retouching all of our cafes. So we want to have great seats, great atmosphere, a place that feels warm, a place you want to be. And then obviously we have been and will always be some of the best benefits, best wages you can find as a partner. And so when you look at it in retail, there's no doubt we have one of the best jobs in retail. And that's the reason we can also see it is we have the lowest turnover in our industry by a lot. Our turnover is below 50% at the hourly level. In this industry, turnover is usually over 125%. So we're definitely doing something right. Yeah. And the feedback I'm getting from our partners is they definitely feel supported, they're engaged, and they love doing the work that they're doing.
I am curious, though, about some of the unionization drives that kind of predated you, but obviously still there as well. Have you spoken with those unions in any sort of meaningful way recently? Are they still demanding more than what you've already offered?
Look, I think we've talked about this. I'd love to be able to find a deal so that we could, get a contract and move on. But it's going to have to be reasonable, and it's going to have to reflect the fact that we are the leader in benefits, wages for people that work 20 hours or more in our company. Because it has to be sustainable so that all 400,000 partners and all 250,000 partners in the United States can continue to have a great experience, a great career, and frankly get great development and growth personally and professionally. So we're always going to continue to have the conversation, and I'm a believer in that you can find a solution, but it's going to have to be reasonable so that everybody can be successful long term.
The U.S. is obviously your primary market, but Starbucks for quite some time had made a real big push into China. At one point, you were the largest coffee chain in China. You've retrenched from that just a little bit, and you've recently entered into a partnership to effectively sell off the majority of that business to the private equity firm Boyu. What is Starbucks going to look like, particularly in China and the rest of the countries? Yeah,
look, I think the one thing I want to be clear on is we do believe China is a tremendous growth market. Today we have over 8,000 coffee houses. We believe with our partner Boyu, that could be 15, 20,000 coffee houses. And they are a great partner for growth. And part of the reason why we decided to do this is for our next chapter of growth, we just believe we needed a local partner to help us kind of figure out how we can grow faster. Because one of the things that has really, I think, been exciting to see, and on the other hand, kind of like, whoa, is the coffee category is really growing. And, some of these competitors that have emerged in China have just, I think, really ramped up their new unit growth. And so we're going to have to get more competitive in our new unit growth story. And I still believe at the end of the day, we have the best product and the best experience. So I believe that'll set us up for success. And I think that's why Boyu is so excited to partner with us, because they see the opportunity as well.
You talked at your Investor Day about this being sort of an asset-light model that you're taking there. Does that also mean that investors should expect maybe slimmer margins because of the fact that you have to share a lot of that money with Boyu?
No, and look, the way we've structured it is obviously, the partnerships are in the cases where we have full license scenario. We don't end up deploying our capital into the markets. We support the licensee in a different fashion through, marketing and menu and technology and, design. So it just becomes less of a requirement on our capital. But it's still, in most cases, you see the margin actually rise and becomes margin accretive to the total business. And the thing that's really exciting is there's so much opportunity for growth. Yeah. And when you have these local partners in these international markets, we just end up, I think, getting access to the premier real estate and at a speed that we couldn't do from our Seattle offices.
I am curious about the scale of this business, particularly in light of some of the businesses that you ran before relatively successfully. For those who don't know, a former brand manager at P&G, you went on, turned around Taco Bell, you turned around Chipotle, now you're just Starbucks. Is Starbucks too big to handle right now?
Oh, no. The thing that's great about Starbucks is the brand is beloved, it's iconic. And when you go around the world, there's no doubt that people want to engage with the Starbucks brand. I was looking at the US, I think we just moved too far away from what made Starbucks Starbucks. And I think you were at our investor day yesterday, and I think Mike said it really well, which is we don't need to change who we are. We just need to be great at who we are and what we do. And that's what we're getting back to doing intentionally, right? So it's like we're going to be intentional about that barista to customer interaction, the customer experience you get. We're going to be intentional about making sure you have a great seat. We're going to be intentional with the menu, the marketing, the digital experiences that we provide. And what I've seen just most recently from this quarter is when we do that with excellence, we get rewarded with customers' business and loyalty.
Brian Niccol, the chairman and CEO over at Starbucks, just fresh off of his latest quarterly report, a return to same-store sales growth and his first investor day at the helm.
All right, we go from Starbucks into space because we do have some breaking news here from Blue Origin. That is the rocket company of Jeff Bezos, putting out a statement that they plan to pause New Shepard flights for a minimum of 2 years. That is in order to focus more on lunar work. You remember Blue Shepard, of course, famous for sending humans, including Katy Perry, I believe, above the Kármán line. We will continue to follow that story. This is The Close.
Time now for our stock of the hour. It's an American Express, down on the day, down on the week, down on the month, on the heels of its latest earnings report. 9% growth in transactions, but, well, expenses also higher, coming in higher than expected. Darrin Peller, managing director over at Wolfe Research, joins us right now to talk a little bit about what's going on. Darrin, they just had a big card refresh. Of course, the platinum card, but of course, refresh, kind of code word for rewards, and those rewards cost money. I spoke with the CEO earlier today. He said it's going to pay off. When?
It's a great point, and it's a great question, and thanks for having me. When you consider the actual growth in card member services up over 50%, you're not wrong to ask it. I mean, at the end of the day, that was a surprise that I think a lot of the street was expecting to grow, but not that magnitude. So the amount they're spending on all these great promotions and opportunities for the new platinum users to have is having an impact on the bottom line. Now, for what it's worth, it does tend to lead with about 2 to 3 quarter lag before you see the revenue really at full force. It's already impacting them now. Yeah. But I think you'll start to see it outweigh the costs by the end of the year and into early 2027.
I am curious, and we should point out, Steve Squeri, the CEO, was very adamant about meeting some of those long-term growth targets at 10% run rate as well. Right. One interesting thing that he talked about that I thought was interesting, he talked about how some of the share of their total client base is getting younger, that millennials and Gen Z now make up their largest share of their spending base at 36%, and the fastest growing, and 65% of new acquisitions globally. I know that's not a short-term story, but long-term, does that sound appealing to you?
It's an incredibly good point, because when you think about American Express, over the past 10 years, 15 years even, it had its life cycles of being the go-to card, the popular card among all demographics, and then it shifted. I think there was a few years you and I both remember where it was not really perceived as the best card for a younger demographic, and now, to your point, over a third is that millennial and Gen Z, another third is Gen X, and then we have only 1/3 that's baby boomers. That's an incredibly strong shift, and not just on the age demographic, but it is still a much more affluent user base, which is pretty good for the economy. In terms of what we're seeing in potential risk of different bifurcated consumer, that's pretty good. They're in the right place to be. And so, look, with that comes more use of these promotions. Younger consumers are more comfortable using things they're seeing on apps that Amex will deliver around travel programs, taking advantage of Uber programs. So you're seeing an uplift in the actual use of the rewards and programs Amex is offering.
All right, Darrin, unfortunately, we're up against the clock. Have to leave it there. Really appreciate your time. That is Darrin Peller. He is managing director over at Wolfe Research. A great conversation you had with the CEO of Amex, who also had comments when it comes to that proposed 10% cap on credit cards, which I haven't forgotten about.
He's not a fan, as you can imagine. He basically said, hey, look, he was very blunt. He said, look, it's going to lead to lower credit lines, fewer people getting credit cards to begin with, and in his words, it really hurt the economy. He also said he doesn't think it's actually going to happen.
Yeah, well, there's a lot of people who would agree with him there.
And you talked about some of the other regulatory issues with the exchange fee settlement, things like that. Obviously, things that potentially affect their business, but overall, he seemed relatively confident here in meeting those longer-term targets.
Well, great conversation you had there. A great conversation we're going to have up ahead with Brian Whalen. He is TCW's Chief Investment Officer of Fixed Income. Don't go anywhere. The closing bells are up next. This is Bloomberg.
Chairman-designate Warsh has a long and illustrious career in history as a very insightful thinker on monetary policy. I think he's a fantastic pick from the president. I think he's got enormous credibility. I think he's got enormous gravitas. I think he's got enormous respect from financial markets, from economists, from everyone. I think he's going to do just a knockout job.
Fed Governor Stephen Miran speaking about Trump's nominee to succeed Jerome Powell as Fed chair. As far as the market reaction, Katie Greifeld, they took it in stride here. I mean, markets are having an ugly day, but that's not really related to the announcement by President Trump.
It's not as ugly as it was when you take a look at the S&P 500, down by about 0.3%. You can see the dollar index having a great day, higher by 0.8%. What is having an ugly day is silver. I mean, it just keeps building, now down 29% for the devil's metal. And I did want to draw your attention to the bond market because you're seeing a really interesting reaction there when it comes to the Treasury curve. You're taking a look at 5s, 30s there, steepening by about 5 basis points right now. And that's where I want to go with Brian Whalen. He is TCW's Chief Investment Officer of Fixed Income. I'm pleased to say that he joins us now. So, Brian, that's the knee-jerk reaction, sending the curve steeper. Do you think that that's the correct one in response to Kevin Warsh's nomination?
Yeah, I think you got right to the point. I'd say it's the correct response to comments we've heard from him over the last 12 months. And so the reason I say that is that, we heard Miran, and he's right. We have an experienced central banker, but we also have one that has been historically comfortable with some independent thought. And he has been a vocal critic of some kind of recent policies, particularly quantitative easing. And that kind of gets you to the curve comment you're talking about. And so the market's perception and the way we're pricing it today, the market is pricing it, is that he is going to be probably less flexible and less willing to use the Fed's balance sheet, otherwise known as QE, to implement policy. And if so, the market's viewing that as a bit hawkish, at least on the long end of the curve. And so that leads to higher rates between like the 10 and the 30-year part in the curve. And the reason he's been critical of that is that he thinks that distorts the flow of capital, the pricing of capital, and what that has led to is his opinion, inflated asset prices, which benefits the top quartile of the population and it benefits the wealth effect. But what it does do, if going down that path, is that it means interest rates generally at the short end of the curve set by the Fed have been too high, and that has been a headwind for a lot of consumers. And so, if he's going to be use the balance sheet less, which might lead to higher short-end rates, in turn, at least the market's belief is that should lead to lower front-end rates. So more dovish in the front end. And that's exactly what you're saying. Basically, the long-end rates are up a few basis points, and the 2-year representative short-term rates is down about 3 basis points.
Well, let's talk about the long end a little bit more because, I mean, I follow ETFs very closely. You take a look at a fund such as TLT, that tracks 20-year plus treasuries. People have been selling and selling that thing for well over a year. And I feel like I've been asking for over a year, what's it going to take to step out the curve a little bit? But for the foreseeable future, I mean, is duration just off the table?
No, I don't think it's off the table. I think it's very relevant to this conversation. We like duration, but we like it in the short end of the curve. A lot of that has to do with also not just Warsh's nomination, but his point too, outside of what I've mentioned already, which is about inflation. And so from our perspective and in alignment with his, is that if you're thinking about inflation, you need to be looking through the windshield, not the rearview mirror. And really what the metrics are telling you is that on a go-forward basis, the cyclical elements of the economy is already down toward 2%. And so inflation is yesterday's battle. And so the Fed, we expect, will eventually kind of come to that realization, maybe led by the new chairperson come May, and lower rates maybe a little bit more aggressively. It doesn't necessarily mean we're going to get a drastic sell-off in the long end of the curve. I think the kind of narrative about sell America, the same thing we saw a year ago, was a little overdone. It was kind of a narrative fitting price action. And another thing I would just add, and it's definitely within the kind of the realms of the market and the conversation, is that even if the long end of the curve comes under some pressure, and even if you have a central bank less willing to use their balance sheet, you do have the Treasury. And there are tools at the Treasury under the Secretary that they can use in terms of like buybacks or swaps or maybe moving issuance to the front end that can help manage and mitigate any kind of rise in long-term interest rates.
I am curious. I mean, you talk about this idea of the Fed's battle. Is there even a battle to fight right now? I mean, in our interview with Miran, he's making the case that, at least in his view and his metrics, inflation is not actually as far off from the Fed's target as it would. And while he does see some concerns in the labor market, he also seems to suggest that it's also pretty stable. I don't understand what's even there to fight at this point.
Yeah, we would agree. Like at TCW, the view is like inflation is yesterday's battle. It's not going to have an issue. That's not really a fundamental concern this year, at least for us. I would say maybe the battle might be kind of currently around the table, the 12 voters at the FOMC, about what they should do in the near term with regards to interest rate policy. The hawks are still maybe concerned about inflation and tariffs and kind of any kind of lingering effect. It's not one we share, but there's something they might say. What I would point out, though, is that, the markets right now isn't pricing the next 25 basis point cut until the summer.
Yeah.
And we have a lot of data to get through between now and the summer, not just us, but the other members of the FOMC. So, even though we have a chairperson going in at the markets perceiving to probably want to lower rates quicker than the current committee, by the time we get to July, and if we're right on inflation, there might not be even an argument amongst the table. There may be close to consensus that, okay, even if we're at the higher end of neutral, it's time to bring that down because we want to protect the labor market.
Hey, Brian, we only have about a minute left, but before we let you go, I just want to get your thoughts, too, just on the corporate credit environment right now, what you find attractive there, not just because of what's going on with the Fed, but just overall. Do you still see opportunity for entry?
I'd say a two-part answer. If you're not really a trader and you're just going to kind of buy corporate bonds and hold them for years and years to come, it's as fine an entry point as anything. Because I think more important than anything is not the spreads, but the absolute yield levels you're buying high quality corporate bonds at, which is very good right now. On the other hand, as you might hear some say, the extra yield you get to buy corporate bonds right now has never been less. You've never gotten paid less to take corporate bond risk today. And so if you're an active investor, we're positioned, and we suggest others, to maybe have some patience, wait for some volatility in the marketplace when the compensation to buy corporate bonds is a bit better, and then kind of move into that area of the market.
Brian, a real pleasure. Brian Whalen, TCW's Chief Investment Officer of Fixed Income, helping us count you down to the closing bells here on this Friday afternoon, a Fed Friday, if you will, to be alliterative, which I can't really say, so I messed that up.
Well, it is Friday, It's been a long week. There was a Fed decision 2 days ago. I kind of forgot about that.
Yeah, I think most of us did here, and I guess the fact we got this announcement today kind of explains maybe some of the body language we had out of Jay Powell at that meeting. Everyone was talking about, hey, he looked like he was ready for get his fishing rod and get the heck out of there.
There's still a long way towards May. It's going to be a long couple of months, I think.
And just a reminder, of course, we still have to go through a confirmation process, so still a bit of a ways to go before Warsh takes the seat. A full breakdown of all of today's market action starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Katie Greifeld taking you through to that closing bell. with a global simulcast. There it is behind me. Carol Massar and Tim Stenovic in the radio room. Welcome to our audiences across all of our Bloomberg platforms, including our partnership with YouTube. A day, Carol Massar, that of course has been consumed by the attention on Kevin Warsh, the nominee to succeed Jay Powell, but it kind of obscures some real volatility going on in equity and financial markets here on this Friday afternoon.
Yeah, it's funny that you say that. One of my gainers, man, was up about 20%. I think.
Oh, I know which one it was.
I know, and I'm keeping my fingers crossed, but it might.
I don't want to spoil it, but when I saw it reverse, I thought of you. I was like, it's going to get Carol, isn't it?
But it's like when we talk about the spread in terms of high to low, it's remarkable. Having said that, Romaine, I am thinking about the S&P 500 for the month overall, 1.3% higher in these last final minutes or seconds of trading. And we haven't seen, I don't know, you have to go back, I think it's the best month since, is it October?
Oh, that far?
Well, not that far, but still.
Yeah.
Come on, think about everything that's happened in this first month.
No, you're right, Carol. And we should point out all of the major indices for the month are in the green.
I just want to bring some news. You guys are talking about the trade. You're talking about the macro. On the micro, this redhead just crossed in the Bloomberg terminal in the time it took us to go to the simulcast. Peloton is cutting 11% of staff, including from the engineering teams. Shares down about 2.5%. It's a setback that's aimed at slashing costs. This is according to a person with knowledge of the matter. This coming from Mark Gurman and team.
Peloton. Yeah, Peloton. I mean, it's so ubiquitous. I Pelotoned this morning, but this turnaround, it seems like they can't exactly pivot.
Through the snow?
No, but I was looking at
I don't know if you know how they work, Romaine.
I don't, actually. Let's walk you through the markets
here. You don't go anywhere. That's what's great about it.
All right, let's walk you through the markets here, because it was a very busy day. And we should point out this is the final trading day of the month. All of the major indices on the day are going to finish in the red. That includes the Dow Jones Industrial Average, down about 0.4%. The S&P down 0.4%. The NASDAQ down 0.9%, and the Russell 2000 down roughly about 1.5%. With the exception of the S&P, they're all also down on a weekly basis. But for the month, and this is to Carol's point, for all of the volatility that we saw, all of the major indices are going to close out the month of January with the gain, and the biggest gainer amongst the biggest indices is the Russell 2000, up 5%.
Wait, you actually think I made a point?
You make a lot of points. I just hate acknowledging them.
I know. You're feeling good. You've had a pretty bad day.
You're actually pretty smart, Carol.
I have my moments, lapses. Hey, S&P 500, 246 names to the upside, 256 to the downside. And Katie, right now we've got, looks like one unchanged.
Yeah, there you go. Well, let's talk about what we're seeing at the sector level as measured by our friend The Circle. It doesn't look that great, honestly. You can see that tech really took a hit today, down by about 1.3% as a sector. Materials slightly worse, down about 1.9%. In terms of what did perform on this up and down Friday, consumer staples was your best bet, higher by about 1.4%. Energy, too, having a good day, higher by about 1% on this Friday.
All right, guys, let's go to some of the individual gainers, and I'm feeling kind of smart right now.
She's feeling good.
All right, let's start with Deckers. Definitely an outperformer in today's session. In fact, it's the #1 gainer in the S&P 500. Isn't that wild? Considering we had like all these big, I don't know. It's just been a funny week, and I just find it interesting that Deckers is there. 19% to the upside. Owner of UGG and Hoka footwear brands, you guys know that, raised its annual earnings and sales forecast, beating the average analyst estimate. Analysts out talking about the name noted strength in the retailer's direct-to-consumer channels across the United States. Goldman Sachs raising its price target to 92 from 81, maintaining, though, its sell rating, which is kind of interesting. But this was definitely an outperformer. And this is the one I was nervous about. SanDisk, check this out, guys, up 25% at its intraday high, at one point down 1.2%, so quite a swing. And at the close here, we're just up shy of 7%. What a move, kind of dramatic.
We were talking about this on the close because we saw it kind of, it was up 25%, and while we were on the close, it's, dipped into the red, and we were just, there was no news. It was just seems like maybe it was just, I don't know, maybe some profit taking, who knows?
I don't know. We broke down the results, right? After the close, second quarter revenue beat expectations. Raymond James upgrading the stock to outperform from market perform. I love all the analyst community, though, running to change their price targets. Susquehanna raising it to 1,000 from 300. Bernstein to 1,000 from 580. Cantor Fitzgerald to 800 from 550.
Yeah.
What's the stock doing year to date, Romaine?
It's up. And I should just also point out, too, I was just taking a quick look here. I mean, this is not surprisingly the biggest, most volatile swing for that stock in its history, the biggest one-day point swing from peak to trough.
How could it not be? I think it's up something like 1,600% or something from its IPO back in February of 2025. So anyway, definitely caught our attention.
It was a secondary offering, but thank you.
All right, a secondary offering.
There he is. There's the Romaine we know and love.
We were so missing you.
I was getting worried.
Verizon, your number 2 gainer in the S&P 500, folks. Let's go there. Finishing up almost a 12% gain here, so near its best levels of the session, holding on to those gains. Company reported its biggest gain in mobile phone subscribers since 2019, plans to buy back as much as $25 billion in shares. Those buybacks planned over the next 3 years and include at least $3 billion in 2026. They've been working on a turnaround, and kind of the read off of all of this quarter is that the company's CEO, that turnaround efforts are starting to bear fruit. So definitely an outperformer. All right, Tim, all yours.
Okay, I actually was going to do Apple today. It was down as much as 2.4% post earnings, and then up as much as 1.4%, but it finished in the green. So honorable mention as a gainer for Apple. Yeah, that was for you, Carol. That's okay.
Thank you for that.
You're welcome. Rocket companies down 13.7% today. Mortgage company stocks tumbled today. This after PennyMac Financial Services reported profits were significantly below Wall Street expectations. We saw other mortgage lenders, including rocket companies, fall. UWM Holdings Corporation also fell. The company's shares declined. This is, I should say, PennyMac Financial Services, as much as 38% earlier in the session. Finally, let's look at a couple software and video game companies together. Unity Software, Take-Two Interactive.
Yeah, this is crazy.
This is really crazy. Yeah. Gaming stocks just took a hit today. This after Google said it began rolling out Project Genie to Google AI Ultra subscribers. The prototype web app allows users to create and interact with a navigable world. Yeah. Look at this. Unity losing almost a quarter of its market cap in a single day as a result of this product announcement from Google. Take-Two Interactive down 8%. I guess this is this like AI hitting this industry? I don't know.
Yeah, I thought the reaction was, I mean, Unity has some other issues too.
Yeah, they've had issues for years.
But I agree with you. This seemed like a bit of an overreaction, particularly given that, we don't actually know exactly how much engagement Google's going to drive with this.
Yeah, and these companies have tried to come out with video games in the past, and it hasn't totally worked, like Apple Arcade, for example. And finally, shares of Bombardier. These ADRs took a hit today, down 6.6%. This after President Trump threatened to slap a 50% tariff on aircraft from Canada and decertify all new planes that are made there. Bombardier is the Canadian aerospace company. In 2024, it got 64% of its revenue from the U.S. Analysts, though, say that the threat could be noise. They doubt the tariffs and decertification threats will be enforced, but the worrying headline could make investors wary. ADRs fell 6.6%.
And just a quick check on yields. Modest moves across the curve, down on the lower end of the curve on your 2-year and 5-year. Your 10-year yield up about 2 basis points, about 3 basis points on your 30-year yield. A bit of a steepening in the curve as a lot of people now trying to speculate as to what a potential new Fed chair in Kevin Warsh might actually mean for the trajectory of interest rates.
Yeah, I think that's the interesting stuff, right? Like, obviously nominated, we've been waiting for it. We've been spending, I know you guys have too, about what he means. I think it ultimately comes down to, certainly for financial markets, right? Is it an independent Fed when all is said and done? We can look at his past history and so on and so forth, but I think that's going to certainly be key. And we'll see whether or not the nomination goes through.
Yeah, exactly. And I'm glad you said that, because I think there's still now a lot more questions than answers at this point. Does the nomination go through is a big one. We heard Senator Thom Tillis earlier on Bloomberg Surveillance say he's a no vote until that probe is dropped into Fed Chair Jay Powell and the Supreme Court case for Lisa Cook is resolved. Does that happen before May to allow a path to actually win?
Yeah, that's a good point. I guess a lot of questions we have to answer, Tim, but I think we got to go. My Peloton's waiting outside.
Really? Oh, you mean it's over?
You know, you don't hear the producer screaming in your ear to rap?
Actually, I don't. No, I'm not hearing anything today.
You guys took the mic, you ran with it. I love it. Good for you.
That's okay.
Have a good weekend. Stay warm,
you too.
Everybody. Bye. All right, that's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We call it The Close. Of course, Katie and Romaine continuing there on The Close on Bloomberg TV, and Tim and I continuing on Bloomberg Business Week Daily right here on Bloomberg Radio. We'll see you again, same time, same place.
If we're allowed back.
On Monday.
We'll see.
Always questionable.
All right, our coverage continues here on Bloomberg Television. A continued focus on the Fed. A conversation up ahead with Representative Brad Sherman, Trosten Slok over at Apollo, historian Peter Conti-Brown, and Eric Sheridan. Paul Romer are also going to be stopping by the program as well. Stick around. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romaine Bostic. Another wild day on Wall Street, a wild week, and quite frankly, a wild month here on the last trading day of January. Stocks pretty much across the board were down on the day, though we should point out the S&P did manage to squeak into a weekly gain, and all of the major indices here in the U.S. did close out the month of January with a gain as well. We did see volatility pick up. You see that reflected in the VIX. You did see the dollar pick up. You see that reflected there on the back of that potential nomination of Kevin Warsh. And whatever happened today in the metals and mining space, particularly when it comes to precious metals, gold, Katie Greifeld, down the most since 1983. That was before I was born. And silver, down the most since 1950, definitely before you were born.
I think you call that a crater, actually. I think that's a technical term for it. Let's take a look at what happened at the individual equity level. Deckers Outdoor, we mentioned it briefly in the simulcast. They reported yesterday boosting their sales forecast. Chevron reporting this morning, I believe, boosting their oil output, boosting shares as well. AppLovin, this company reports next week. For whatever reason, they're down about 17% today. Evercore said this move looks directionally incorrect. We'll see if it reverses itself. But let's get to our top story this hour, and that is Kevin Warsh. He gets the nod. President Trump tapping the former Fed governor as the next chair of the central bank, a pick viewed as more hawkish than other contenders. Now, roadblocks to confirmation still lay ahead, though, at a time when many economists and investors see Fed independence under threat, Romaine.
All right, well, who better to talk to about that Fed independence than the man who wrote a great book about it, The Power and Independence of the Federal Reserve, by Peter Conti-Brown, Associate Professor of Legal Studies and Business Ethics at the Wharton School at the University of Pennsylvania. I think you wrote that book almost a decade ago, Peter. You're going to have to update it in a few months?
I've got to. This past year has aged me 10 years. I'm still trying to get used to you being younger than 1983, by the way. But I feel like I might have been born before 1950 after what we've lived through in 2025 with respect to Fed independence.
Well, it gets to this idea of where exactly we go next. And I don't want to impeach Kevin Warsh's character in any way or another. But we knew heading into this, whatever nomination process was going to be, it was the president was looking for somebody that would ratify his general view of where rates should go. Whether Kevin Warsh actually goes along with that, should he actually be confirmed, he's going to have to contend with the perception by the market that maybe the thumb is on the scale.
I think you're right. And Kevin Warsh, more than any of the other three finalists, is acutely sensitive to market signals about Fed credibility and about his own reputation. I take that as a good sign. We want a Fed chair who is sensitive to that key idea. We talk a lot about Fed independence, as we should, but the reason for Fed independence is not an end in itself. It's to accomplish something, and that's Fed credibility. It's Fed credibility about inflation, about monetary policy, about unemployment, about managing the business cycle. And President Trump's view of interest rates is incredible. It's not credible, and markets don't see it as credible. So Kevin Warsh did not get the nod in 2017 precisely because Donald Trump saw him as too much of an inflation hawk. He's changed his mind, obviously, now, almost a decade later. And we have to ask ourselves, is Kevin Warsh, is he a MAGA prince or is he a master politician? Did he survive this crucible so that he could be what we would consider more of a mainstream establishment-oriented Fed chair?
Yeah, it's interesting. And I think a lot of folks on Wall Street are asking that question, who is the real Kevin Warsh when it comes to his stance on where interest rates should be at the moment? Certainly, he's gotten in line with the rallying cry of the Trump administration that they should be lower at the moment. But it's interesting. In November, we saw Warsh basically detail the approach that he would take as Fed chair. And this point basically stands out to me, that he is saying that fundamental reform of monetary and regulatory policy would unlock the benefits of AI to all Americans. So he has an idea here about how to reshape the central bank, not just necessarily ideas about monetary policy, but how to reform the institution as well. And I wonder what you make of that.
speeches and op-eds and interviews that he gave in 2025 were a little bit of a word salad. And I have no idea what he means by the idea that AI will unlock a fundamental rethinking of monetary policy. I don't think that makes really any good sense. Basic tools of monetary policy, and indeed, I love the banner on our interview right now, this reinvented Warsh. I'd like for Warsh to be back to where he was. He had some very serious, very rigorous critiques of the Fed losing its way, drifting. He has some concerns about the Fed's balance sheet. And I think that those critiques are all fair and good. The reinvented Kevin Warsh is the one that makes me nervous. We don't want a Fed that joins in any kind of sudden technological innovation and then throws out a playbook, which has led to a kind of Pax Americana and the US dollar dominance for nearly a century. Lots to reform, but these are marginal reforms. We want evolution, not revolution. The Kevin Warsh from before 2025 was more of an evolutionary reformer. In the past year, as he's auditioned for this role, he seemed more like a revolutionary. That makes me nervous.
Well, you know, it's interesting. And I referenced this note from Neil Dutta of Renaissance Macro to Stephen Miran about an hour ago at this point, actually. And the word that Dutta used was suspicious, that he's suspicious of this seemingly dovish posture that Kevin Warsh has taken on, making the point that, you know, for pretty much all of his professional career, he's been sort of cast as this hawk. So, Peter, you know, you talk about this pre-2025 Kevin Warsh. I won't ask you to look too far into the future, but do you think that, you know, that version of Warsh will come back once he's in the seat for some amount of time?
I do think that, and I think that this pick, should he survive the Senate confirmation that you all were talking about earlier, which is non-trivial, I think Kevin Warsh will return to his roots. And I think this because for his entire career, he has been the kind of central banker who cares about credibility. Some of the other candidates cared about the credibility relative to a single person. And that's the one person we don't want to capture the mind space of central bankers. That's the sitting president. And Kevin Warsh has a long history with the Trump administration. There's a family connection there that people are talking a lot about today. But fundamentally, Kevin Warsh is someone who cares about American institutions, he cares about the Federal Reserve, and he cares about his own reputation. Mm-hmm. And I think that's a key point. Someone who is indifferent to those factors, who really just wants to do what the sitting president wants from them, that's the disqualified central banker. I don't think that's Kevin Warsh.
Well, I'm curious, too. I know you refer to his family, obviously married into the Lauder family. I am curious, though, too, as to how he's going to be measured in terms of the type of Fed chair we get. There are a lot of people have been talking about kind of the trajectory of Fed chairs we've had over the years, going from more, you know, kind of academic wonks to, you know, somebody like Jay Powell, kind of a, you know, more market lawyer kind of focus, and now ostensibly, I guess, to a certain extent in Warsh, more of a market animal. Is this sort of the evolution, if you will, for better or for worse, of the leadership of the Fed, that maybe it shouldn't be left to the policy wonks? Maybe it should be folks who do know a little bit more about the markets, or at least can posture that they know more about the markets.
I think that the answer to that is yes, in a sense. The reason I pause here is that I just don't think there's a through line in Fed history. We've only had one true dyed-in-the-wool academic economist for his entire career as Fed chair, and that's Ben Bernanke. Janet Yellen spent most of her professional career in and around politics and central banking. Alan Greenspan didn't get a PhD in economics until he was in his 50s, and his dissertation was basically NYU giving him the gift of an honorary degree. Paul Volcker was not an academic economist. Arthur Burns was a little bit, but he was more of a political guy. So I think the best way to think about it is that each Fed chair kind of stands for something different. And each one is shaped by the influence of a predecessor. So when you hear Powell, think Volcker. Those are some of the main, that Volcker is one of the main inspirations here. And I think Kevin Warsh has a decision to make. Is he going to be more like Thomas McCabe? This was Truman's Fed chair, appointed to bring the Fed closer to the president, but then declared his independence and facilitated the famous Fed Treasury Accord in 1951? Or is he going to be more like an Arthur Burns, who just ends up torching his own legacy by the perception that he was not independent of Richard Nixon, or in this case, Donald Trump? And that choice, should he be confirmed, would be one that Kevin Warsh has to navigate.
Yeah, it'll be fascinating to see how it plays out. Peter, great to get some time with you on this Friday. That is Peter Conti-Brown. He is Associate Professor of Legal Studies and Business Ethics at the Wharton School at the University of Pennsylvania. Now, coming up later this hour, Trosten Slok, he is Chief Economist over at Apollo, Representative Brad Sherman of California, that is, and Nobel laureate Paul Romer. All that and more coming up. This is The Close. Well, Trosten Slok of Apollo weighing in on Trump's Fed pick of Kevin Warsh, writing, quote, "The muted market reaction today tells you everything. The market is comfortable with Trump's choice." Trosten, I'm pleased to say, joins us now. And you're right. I mean, you take a look at what's going on in the Treasury market, a little bit of steepening, a little bit of a decline when it comes to the S&P 500. The metal space, a whole different story. But overall, it seems like this was either priced in or, to your point, this is a Fed chair that the market can live with.
I think that is the conclusion. I mean, the market is saying here, maybe the dollar went up a little bit, maybe signaling that there is some issues here, that maybe there were some sigh of relief about some of the other candidates. We don't really know the backdrop for why markets, in particular the FX side, did move the way they did today. But the conclusion is exactly as you're saying, Katie. When you look at rates, it was not the case that there was any signal here that the market is worried about institutional erosion or worried about independence of the Fed chair. So I take this as the number one conclusion, namely that the market likes this candidate.
I am curious it gets to this idea here of what starts to happen, assuming that Warsh does get confirmed. Jay Powell goes off into the night. Do you think the process, Trosten, overall, and I mean that for those of us from the outside looking in, the people in the markets and the economists, that it's pretty much going to be the same? I know there'll be a lot of drama and other things that we'll make of it in the media, but do you think it's pretty much going to be the same?
Well, I think at least if you go back and look at previous Fed picks, whenever a name is announced, there's always a lot of questions. We all go back and read the tea leaves of what does this person say. And in this case, we're going back and looking at what does this person say 20 years ago. I mean, it is slightly stunning that people put so much weight on what Kevin Warsh has been saying 15, 20 years ago, because, of course, the economy is in a very different spot, in particular when it comes to AI, relative to where we were in the mid-2000s. So to your point here, Romain, I do think that there is a lot of drama here today about, oh, what is this going to mean, and is it going to be a dramatic change? But the bottom line really is there are 12 voting members on the FOMC, 7 governors, and 5 regional Fed presidents. And we just learned this week that the decision that they made was 10 of these members think that interest rates should not go down. 2 of them think that interest rates should go down. Mm-hmm. So if we do now add Kevin Warsh maybe to the side of saying maybe interest rates should go down, you still have 9 members that are thinking that interest rates should not be going down. So really the key issue to watch here is how is the committee going to evolve in its view? And I absolutely think that Kevin will be seeing this from a data-dependent perspective. What is the data telling us? If the data evolves in a way where the economy is slowing down, of course interest rates will go down. But if the economy continues to be strong, then there is no reason to cut interest rates at this point.
Well, Trosten, let me just say, I stand by everything I said 15 years ago, but I take your point when it comes to interest rates. But let's talk a little bit about the balance sheet, because he's been much more consistent, much more recently, that is, when it comes to the balance sheet and the proper size of it. And you talk about how he's just one of 12 votes. When it comes to building consensus, I mean, how much of a lift do you think it will be to bring around the whole FOMC to his views on the balance sheet?
Well, you're right. But you can also view the balance sheet discussion in light of what happened after the financial crisis in 2008. What, of course, happened was that the balance sheet was very aggressively used in response to helping the economy out. And that did indeed generate, there's broad consensus about this, an increase in asset prices. Ben Bernanke spoke about this repeatedly, that when asset prices go up, we are trying to generate a wealth effect. So one way of seeing this is indeed that, well, but maybe the rise in asset prices has been very strong for a very long period. And I think that Kevin Warsh's discussion at the time was really more discussing and debating, well, is it a good idea for the central bank or the Federal Reserve to boost asset prices the way that they did after the financial crisis? And today, of course, the discussion is completely different, because this is now happening in the context of an AI boom. And an AI boom is ultimately going to result in lower inflation. So that's why, let's see what he says. His first speeches will become watched very, very carefully. Every single footnote will be read in a very, very careful way. But let's see exactly what his views are, especially in the world that we live in today.
All right. Trosten. Well, we got to get you back much sooner than that. Trosten Slok, chief economist and a partner over at Apollo, as we continue our coverage here over potential changes coming up ahead at the Federal Reserve. And of course, that's all dependent on whether the U.S. Senate actually goes along with this potential nomination. A conversation up ahead with House Representative Brad Sherman. He joins us next, right here on The Close on Bloomberg.
This is all about sending a signal to the markets and to the business community that Fed independence is critically important. And going after the chair, I think, took a stool out of the foundation of people's confidence, or a leg out of the stool.
Senator Thom Tillis, the Republican from North Carolina, on Bloomberg surveillance earlier today, warning that he still plans to block the nomination of Kevin Warsh to be Federal Reserve Chairman. He says this will be until the Department of Justice's probe into Jay Powell is resolved. It's raising a lot of questions as to how Congress will receive this nomination and whether they will vote on it based on the merits of Kevin Warsh or more on the merits of Donald Trump. Joining us right now is U.S. House Representative Brad Sherman, who's represented the state of California for almost 30 years. Great to have you here, Congressman. You're also a member of the House Financial Services Committee, as well as the Foreign Affairs Committee. I know this nomination doesn't necessarily go through your committee, but you're certainly going to have a say over Kevin Warsh's nomination. And I am curious as to what most you want to actually hear out of Warsh if and when this nomination actually gets to a hearing.
First, I want to make sure that he believes in Fed independence and that the decisions are going to be made by the Fed and not by the administration. Second, I want to hear his comments about both the balance sheet and interest rates, but I think he's established himself as a mainstream thinker. Now, whether he's 25 basis points this way or 25 basis that way, given how terrible some of Donald Trump's appointments have been, anybody in the range of reason is a step up. This Warsh is not the JFK Jr. of Federal Reserve decisions. The final concern I have is on crypto, where he has been very involved in crypto, and the whole purpose of the Fed is to maintain the value and the popularity of the U.S. dollar. Crypto is trying to compete with that, and I would hope that he would be loyal to the dollar and would take a clear position that crypto entities are not going to be bailed out by the Fed.
I am curious, though, when you say all of those things, one of the biggest concerns about this nomination is the idea that the president himself had made it clear the type of Fed chair that he wanted based on the jawboning of Jay Powell. No matter what Kevin Warsh says, are you going to believe him?
I believe that he is a mainstream someone with mainstream economic views, and he has established that. He then has to convince me that he is tough enough to withstand the pressure, the way Jay Powell has, even under this criminal investigation. Then, even if he's good, I understand Senator Tillis and others who say stop this appointment until this investigation is completed, and the effort of this investigation, because this is a phony investigation, to intimidate the Fed is brought to an end. And then I've got my concerns about crypto. On the other hand, Warsh has said that he's for a digital dollar, and that is competition that crypto deserves to have. If you're going to have electronic transactions in crypto, there's no reason to tie the Fed's hand and not have electronic transactions right out of the Federal Reserve.
Well, I actually want to go back to what you were saying about Senator Tillis. Of course, he was on Bloomberg Television earlier this morning. And actually, when it comes to Warsh, he actually likes Warsh as a pick, as the nominee for Federal Reserve Chair. Nevertheless, he did say that he would continue to block any nominee until that pressure on Fed Chair Jerome Powell and Lisa Cook is alleviated. But do you see any realistic chance that President Trump actually backs off from that investigation?
He backed off on invading Greenland. He's backed off on a lot of things. Taco stands for Trump always chickens out. And so I wouldn't be surprised if And they only need to do this by May. I wouldn't be surprised if they figured out a way to wrap this up. There are federal building projects that go over budget. That's not a reason for a criminal investigation.
All right, we'll see. It is a good point, and there is a long time until May here. I am curious, how are you thinking about the state of the economy right now? President Trump, the administration, clearly has voiced a preference for lower interest rates. It seems that Fed chair nominee Kevin Warsh agrees with that. But how are you feeling about inflation and where basically the right level of monetary policy is to meet that?
Well, some of God's greatest gifts are unanswered prayers. If Trump had been successful in lowering interest rates below where economists thought they should be 6 months ago, we would have high inflation now. And from a political standpoint, what's at greatest issue is prices. I suspect that if there are politicians around the president, and there certainly are, that they will try to push the Fed to cut interest rates to as low a level as possible this summer on the theory that people enjoy getting the low interest rates and the inflation doesn't happen till after the November election. So I think we need an independent Fed. I think that Warsh is within the range of reason as to the decisions he will personally reach. And the real question is, does he have the backbone, and does the rest of the Fed have the backbone to stand up to Donald Trump and his whole team? Clearly, having an independent central bank is critical for the United States. We saw how Turkey's economy was severely damaged by President Erdogan's interference in their central bank, and the world depends much more on the dollar than on the Turkish currency.
All right, Congressman, have to leave it there. Really appreciate you taking the time on this Friday. That is Representative Brad Sherman of California. And stick with us. Nobel Prize-winning economist Paul Romer joins us after the break. This is The Close on Bloomberg.
We continue our coverage of Trump's pick to succeed Jay Powell as U.S. Fed Chair, Kevin Warsh. Our next guest, he needs no introduction. Paul Romer is the co-recipient of the Nobel Prize in Economics back in 2018, a professor over at Boston College, also former chief economist over at the World Bank. Great to have you here, Professor.
Good to be here.
I do want to start off here. The President of the United States just publishing an op-ed in the Wall Street Journal earlier today talking about his tariffs and the idea that when he imposed these tariffs, they started talking about them, there were all these predictions for a massive inflation spike. He basically says it didn't happen, and in his view, he thinks those tariffs made us stronger. And I bring that up kind of in the context of Kevin Warsh, of course, who has a dual mandate, obviously a focus on the labor market, but also a focus on inflation. And it raises a lot of questions about where inflation actually is right now. Is that headline number that we look at, that official number, is that reflective of where we are?
You know, maybe I've just been around too long, but this time reminds me so much of the 1970s. And when Richard Nixon appointed Arthur Burns, this feels to me just like that kind of move. It doesn't look like inflation is a problem now, and it's true that people were expecting inflation to start up more quickly. I mean, the dollar is down by 10%, so even if you didn't have tariffs, imported goods are going to be 10% higher. You would have expected to have seen some increase in everyday goods and services, but it's like all the people in a theater, they smell smoke, but they're all looking around and nobody's moving and everybody's kind of waiting. Like, is this kind of real? I think it doesn't look that bad, except look at these speculative prices. You know, if those are indeed a bet on inflation, they came down a bunch with Warsh.
Right.
So that means, okay, it could have been worse.
Yeah.
You know, so.
Well, I mean, you're referring to that big pop that we've seen in a lot of real assets, primarily precious metals and other things, and there was a huge downdraft today.
Yeah, but look over the course of the year. Like silver was up by from $30 to 120. Yeah. It's gone back down to 80. Yeah. But it's still up, you know, at 80 rather than 30. You know, gold is about twice as high. So this just feels, and the dollar is falling. It feels just like the 70s to me. And I think all you're going to need is one shift in perceptions where all of a sudden everybody starts to run for the exits.
Well, I just want to ask you, though, on that historical comparison, there are a lot of people talking about Arthur Burns. We just had Peter Conti-Brown, a historian, on. He actually made the reference to Thomas McCabe, who was the Fed pick under Truman, and kind of drew similar similarities. The idea that a president wanting somebody who would actually be a little bit more mindful of what the president wanted rather than what the economy wanted. And I am curious, is there evidence, though, I guess there is evidence with Burns, but is there evidence, though, that that was dramatically hurtful to our economy?
Oh, absolutely.
Okay.
In Burns, we were already facing some increase in inflation, and Burns engaged in a whole series of measures that substantially, aggressively pursued stimulus from the side of the Fed. And, you know, we ended up with a horrible inflation that took us 10 years to get out of. So everybody agrees that Burns was a terrible central banker, and yet when he was going in, it was just like with Warsh. Everybody was saying, he's a good guy, he's got the right instincts, he's well-trained, it's going to be great. But I think people underestimate the role of the context. And right now, you have a president who does not believe in central bank independence. Like when Nixon appointed Burns, he joked, well, I respect his independence, but I hope he will independently conclude that my views are the ones he should follow. You know, I mean, it was just like a joke, and I think Trump treats it that way as well. So whatever Warsh tries to do, when you're in a context where you got a president who might prosecute you with the Department of Justice, you know, if he gets unhappy, and he wants to tell you what to do, it's kind of, I think, unrealistic to think that just one person who's strong is going to stand up to that. And I have to say, too, when you say could have been worse, I can't help but think about a young Frankenstein. You remember when, you know,
Wilder,
Marty Feldman says, it could have been worse. It could be raining. Thunder, rain. You know? So we need to just wait and see what happens with this one. But you know what I think could really tip this?
What's that?
It's going to dawn on people that, like a year and a half after Nixon appointed Burns, he imposed wage and price controls. And you might have thought we would never, I thought never in my lifetime will we make that mistake again. I think it's entirely possible that Trump will decide to impose wage and price controls again. Because
we know how that turned out, though.
Yeah, we know, but look at like what measure have they done? He's already proposed a cap on interest rates, credit card interest rates, a 10% cap. It's just a way to force a price down to deal with affordability. His instincts go right in this direction of just mandates, and so, and as soon as everybody starts to think maybe we're going to have wage and price controls, everybody's going to have to get their price increases in before the wage and price controls come in. So I think we're much closer to a tipping point of fast inflation than most people are realizing.
Paul, I am curious whether you take any comfort in, you know, Kevin Warsh's public history as being perceived as hawkish. You think about his time as a Fed governor from 2006 to 2011. I mean, he was not supportive of lower interest rates, even in the depths of the financial crisis. Is that any comfort to you?
You know, honestly, no. Look, he's been in favor of lower interest rates ever since Trump got elected. So, and you know what the dynamic is there. He wanted to be considered for this job. And he knew he was dealing with a president who wouldn't even consider him unless he was willing to, you know, pretend at least that he was in favor of low interest rates. So you've got a president who forces people to compromise on some of their deeply held positions to even get considered. You know, maybe this is just like an act, and then once he's in the chair, he'll go back to form. But, you know, even if you're married to a billionaire, nobody wants to get indicted by the Justice Department. So I think the fact that Trump wants to push interest rates down, stimulate the economy, that's the overwhelming context here. And whoever the Fed chair is, I don't know what they can do about it. And remember, Nixon won the election. Like, the economy boomed, and he won the election that Burns teed up for him. All of the costs we incurred came afterward.
And I do want to go back to, you know, the reference you were making that this does feel in some ways like the 1970s. I have to admit, I don't remember what happened back then. But I wonder how far you can extend that parallel, because again, looking at measures of inflation right now, it feels like we're under control. I mean, can you sort of overlay a timeline onto when you think inflation might actually start to bite again?
If you had asked me 5 years ago, I would have said we're never going back to the 70s. You know, we've anchored expectations. We believe in central bank independence. So much has changed. We're never going to make those mistakes again. But I couldn't believe that I found myself thinking, wow, you know, we might actually, you know, when I read about the 10% cap on interest rates, we're on the path towards wage and price controls again. So 5 years ago, I would have said, yep, we've learned our lessons, we've moved on. Now, I think nothing is going to surprise me.
I am curious, though, too. I mean, one of the arguments that certainly people in the markets have taken to sort of give them comfort is the idea that this is still a committee, and the idea that one man or woman does not make the decision as to where rates will go. Do you find any comfort in that? That particularly with the last meeting you had, I mean, you had two folks advocating for lower rates, but that was it. Everyone else, even some of the more dovish people, I put that in quote marks, basically was fine with leaving rates where they were.
So Lisa Cook was a student of mine, and you know, let's see if Lisa's still on that committee, because you know Trump is trying to charge her with this phony mortgage. You know,
you think he's going to win that Supreme Court case?
I don't know, but you know, Trump isn't. If the other people on the committee are getting in his way, he's got other levers he can pull. So
all right. All right. Well, Paul, we have to leave it there. Really good to have you.
Yeah. Well, it's deja vu all over again. The 1970s, here we come.
We'll come back soon.
Well, that's great, because Katie did not live. I didn't either, if you believe that. So we'll get a chance.
Yeah,
together
absolutely.
To see it for the first time.
Paul, come back soon. Stay warm this weekend. That is Nobel laureate Paul Romer. This is The Close on Bloomberg. We'll be right back. Well, President Trump's Fed chair pick overshadowing what was a big week of tech earnings, but the earnings bonanza is far from finished. Amazon and Alphabet headlining next week, but you also have Uber, Reddit, Snap, all on the docket. Eric Sheridan, he is co-lead of the Technology, Media, and Telecommunications Group at Goldman Sachs. He joins us now. Eric, it's great to see you on set.
Thank you so much for having me in.
Before we look ahead, let's look back, and let's look back specifically at Meta, because boy, it was interesting to see shares absolutely soar after earnings. Such a different picture from what we saw at the end of October. What do you think was behind the enthusiasm here? Because if it was CapEx that explained the October drop, did that actually reverse somehow and explain what we saw in terms of a pop?
There were two narratives. The OPEX and CapEx that they finally guided quantitatively 1 year forward was better than feared. It was elevated, but it was better than feared. And the way they guided the revenue 1 quarter forward was much better than expected. So what investors took away from it is applying more compute to your own usage of Instagram and Facebook and WhatsApp is generating more relevant content, which is generating more impressions, which is generating more monetization. And we think the AIification of ads is still in the very early innings as a broad secular theme for the industry when you look out over the next 12 to 18 months. Mm-hmm.
And it was interesting to see that really open-armed reception of the Meta results, because Microsoft, boy, they had a tough time, which was interesting because when it comes to cloud growth, I mean, the numbers weren't that upsetting, but certainly you saw Microsoft shares really get a chunk taken out of them. When you think about some of the concerns around cloud, maybe some of the disappointment that those figures weren't a little bit higher, how does that set us up for Amazon next week?
Well, these cloud computing businesses are never as linear quarter to quarter as investors would like them to be. So there are dynamics around how much of this compute are you going to use internally for your own systems, how much you're going to use externally and show to your customers, how much capacity is actually coming online. 6 months ago, Amazon was going through a lot of what Microsoft is going through now. They were trying to build Alexa Plus. Their Project Rainier dynamic had not yet gone online. Anthropic was not growing the way it is as a private company. Now you look, and 6 months on, AWS is re-accelerating revenue growth, mostly because of external use cases, AI and non-AI workloads, and more capacity coming online. Google Cloud is very different. Google Cloud is at the sweet spot of where enterprise computing and consumer computing is going right now.
Well, speaking of Google and Alphabet, I do want to go back to the ad side of the business, because I thought it was interesting what you said about Meta and sort of the AI ad space. I mean, Alphabet, let's face it, for the most part, is still an advertising company here. Are they going to benefit in the same way that Meta is, or is that a different story?
They will, and you and I spoke in the summertime, and you were nice enough to have me in when we wrote this report about how $300 billion of profit pool in advertising could be disrupted by AI, and we called it the AIification of ads. And most people I knew in the ad industry thought I was sort of writing the quiet part out loud and didn't really like the report about how much of ads were going to shift towards automated buying, automated creative.
Right.
And there are only a couple of scaled companies that have enough data and enough compute to build it.
But to that point, you say shift. I mean, that's kind of what they've been doing for a while. I mean, that shift has been going. I mean, that's kind of the secret sauce for Meta and for that matter for Google. But it gets to the idea of how much further they take it. And is it kind of the winner take all that everyone seems to be making this out to be?
We think a few take most is a better way to think about digital advertising. Who has enough data? Who has enough scale of compute? Who has enough scale of engineering talent? We would put Alphabet, Amazon, and Meta in that camp. There's a number of smaller players as well, but predominantly a handful of players will earn the outsized operating profit gains from these ad shifts.
All right, Eric, we have to leave it there. Got to get you back next week. Eric Sheridan, co-lead of the Tech, Media, and Telecom Group over at Goldman Sachs Research, ahead at the end of a busy week for tech and ahead of another busy week for tech next week with Alphabet and Amazon reporting. Also could potentially be a busy week for Disney.
Yeah, the headline there, the redhead from the Wall Street Journal, that the Disney board expected to vote on the next CEO next week, Romaine. So you talk about succession at the Fed, succession planning underway at Disney in a big way.
And just a reminder, February 2nd, that is Monday, Disney is already scheduled to report earnings before the bell. So we don't know exact timing of when this vote may come. But of course, a lot of questions going to be asked about that. The Wall Street Journal actually saying Iger's actually going to leave his contract early.
Yeah.
So this doesn't sound like a succession. It sounds like we're going to basically name somebody and Iger is finally, maybe for good, going to ride off into the sunset?
Well, it's interesting. So December 31st, that's the end of his contract. But according to the Wall Street Journal, he's expected to remain CEO for several months after they announce the new leader. So he's not going anywhere just yet. Don't worry.
All right. Well, when he does go, you're going to hear it first here on Bloomberg. Really appreciate you being with us this week. It has been a busy week, even busier next. Katie and I do hope you join us again right here on Bloomberg.